Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Welcome in to Make Your Money Matter. I'm your host, Brad Barrett. I'm also managing director and partner here at One Capital Management. And our goal with our show each week is to aim to help you create a better relationship with your money. And this week, we're going to touch on volatility versus variability. Now, if you listened to our show last week, you know I went into two definitions of volatility. One was standard deviation, which is the statistical measure that quantifies the amount of variation or dispersion of a set of data points. And the other one was implied volatility, which is a measure of market participants' expectations, you and I. Now, we got a lot of comments, some emails, some phone calls on this, and so I really love the feedback, so I wanted to go one step further. There was a lot of questions that I think were really good ones as it relates to volatility being a measure of risk. And I want to define that today because I think there's a lot more to dissect on that. But before we get started, make sure to go to our website at onecapital.com. You can click on the media tab and there you can download and subscribe to the Make Your Money Matter show. You can also download our podcast on Spotify or SoundCloud or the Apple iTunes app or Google app on your phone. Do me a favor. Leave us a message, leave us a review. It always helps us share the message. And with that, let's get started. Let me start off with just saying something that I think is very common, knowledge for all of us. Like most of us human beings, we try our best to avoid people, places, situations, right, that are volatile. And the reason, of course, for this is they generally involve what? They involve risk. So when it comes to investing in my world, right, especially in the capital markets or the stock market, most equate volatility with risk, which is why last week on our show, I talked about that, how we quantify quote unquote risk. Now, here's something I want to share with you. It's a little bit of a mic drop moment here. We here at One Capital Management believe that is misleading to equate volatility with risk. Now, that statement alone that I just made is actually risky on our part. And let me explain our view, let's say, on this volatility issue. So generally, when the word volatility is used in reference to investing, let's just go there, right? It's used to describe typically a large decline or maybe period of like rapid ups and downs in the prices or returns, right? We can all agree on that. So let's first look at how volatility is defined from a well-trafficked investing website, Investopedia. I'm using this, friends, because I think most people out there will start with some general ideas like either, Investing for Dummies, the book, which by the way is a great book, and also going to places like Investopedia. So I'm going to use this for a second, and I looked this up, okay? On Investopedia.com, it says this: volatility is a statistical measure of the dispersion of returns for a given security or market index. In most cases, the higher the volatility, the riskier the security. And we talked about this last week on our show. If you want to go back into more of the statistical analysis of how we look at volatility, refer to last week's show. Now, indeed, volatility, as I shared last week again, is the statistical measure of the dispersion of returns for a given investment or overall portfolio. However, in an investment or a portfolio with a higher dispersion of returns doesn't necessarily mean it's risky. I want to repeat that. Just because you have higher dispersion, meaning differences of returns, it doesn't necessarily mean it's risky. It just means the returns had a higher degree of variability around the average of the investment's individual returns over a given time period. So let's go back for a second, all right? I want to simply define or redefine volatility as variability. So I'm switching gears here this week. So I want to redefine volatility as variability. So as such, variability is not risk, okay? So unless you're forced to sell into the downside of the variance, then it becomes risk. That's a whole other side part here, but let's go through this. It's risky to take on too much variability when your time horizon is short and you don't have enough ample, stable assets to access if necessary, right? We talk about this a lot in planning for my clients out there. We talk about liquid reserves, emergency funds. We also talk about your, middle, short, and long-term buckets or overall time period. These matter. Now, otherwise, with adequate time and assets, okay, you can hold a great investment through periods of variability, especially the downside. So variability here, and here's what I'm getting at, because obviously this year we've seen, a big uptick in the markets, but we're also coming off a bear market from last year. Okay, markets in general were off almost 23%. Now our portfolios at One Capital weren't because we have diversification and we manage variability and volatility well. But variability can provide an opportunity for disciplined investors. I mentioned this last week as well, that volatility can be a good friend to you if you know what you're looking for. So we should, in the words of Warren Buffett, as an example, view it as our friend rather than our enemy. Profit from folly rather than participate in it. Remember here, everyone, that investing in the market is buying and selling ownership of a business. That's like its purest form, okay? If careful analysis tells us that the intrinsic value of a business, the current price, merely tells us if it's overvalued or undervalued. That's our job as portfolio managers for our clients, is to help determine that. But we focus on the intrinsic value. Let me give you a little story, an allegory. And this was actually created by a famed analyst, a guy named Benjamin Graham. He helps demonstrate this. Now, for all of those finance nerds out there like me, if you know Benjamin Graham, he kind of wrote the Bible, if you will, called Security Analysis. He's one of the co-authors with Dodd on this thing. But imagine this, all right? Imagine this allegory. Just follow me here. Imagine you co-own a healthy, stable, growing private business with Mr. Market. Now, Mr. Market is an emotional guy who swings from wildly optimistic to darkly pessimistic. Many of us are probably thinking of a friend that we have. We all have them, okay? We love them. Now every day, Mr. Market comes to you and either offers to buy your interest in the company or to sell his share to you. He's up and down all the time. Now, when he's feeling sunny, for example, he offers a very high value or price to buy your share. Now, when he's sure the sky is falling and doom and gloom is happening, he offers what? A very low price to you. And he's persistent on this, right? If you're uninterested in an offer, he'll be back the next day with a new one. This is how this works. You know that the gloomier Mr. Market is, the better chance that one day he will offer to sell you his share at a price so low as to be considered foolish, folly, as Mr. Buffett says. And this is the time when you profit. See, variability can help correct market imbalances. That's actually what we're trying to do as market makers and managers of portfolios. Now, in many ways, the investment world is somewhat Darwinism, right? Survival of the fittest, as we learned. And higher variability often does what? It thins the herd. In periods of higher variability, corporate shortcomings likely get exposed, right? And investors, the marketplace in general, who bought without studying the company fundamentals or the sector fundamentals or the industry's fundamentals, often sell in the droves.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
I want to share something very loud and clear, because I think a lot part of our this weekly show that I like to do for everybody is largely around education and realizing that all the noise that we hear matters, but it also matters how we filter it. Like a pastor used to tell me that we are in control. We are the air traffic controller of the thoughts that enter into our minds. Now, I shared a couple weeks ago, because I thought it was a fascinating stat, that on average, the human being, men and women, have about 60,000 thoughts every day. Now, let's say that you think, Brad, that's a crazy stat, because honestly, I don't have the cited source, and I might have read that somewhere, and maybe it's not true. I don't know. But let's just say that it is for a second, because I did read it. And my first reaction, probably like you, was like, that seems like a lot. So let's just say for a second that they were off by a zero. And let's say the actual thoughts that go through your mind every day is 6,000. Even that is a ton of thoughts. Now, the better question is, how many of those thoughts are positive? How many of those thoughts are optimistic? Remember our friend, Mr. Market, who we co-own the business with? Are you the emotional investor that is riding the lightning every day, and every day is some new emotion? And if we really dig down into it, because a lot of what I do with our clients here at One Capital is really digging down into the psychotherapy as to their emotions around the markets, because it typically comes from something they heard, something they learned, and that's all good. But we need to be able to talk it out and really fundamentally, again, go and derive the intrinsic value of the company that you might be fearful of the sector or the part of the economy that you are fearful of. This is how we don't become a part of the herd. This is how we really get down to the root of the intrinsic value and realize that if we're longer term investors for this portion of our money, for example, this is like retirement plans, it matters, right? It matters how we react. As I share all the time, what we do versus what we don't do in market volatility is what sets us up for success. And we at One Capital, let me just speak for us for a second, because I want to share this with all of our clients listening and all of our weekly listeners. We're so grateful to have your ears each week. We are always looking for those opportunities created during high variability markets. And we're also buying companies and asset classes of different characteristics. In essence, as we know the word I'm going to say, we're diversifying across various economic sectors, various geographic regions, as well as big and small companies in fixed income versus equities. So we're diversifying throughout. We also set risk parameters. I think that's really important because we're talking about variability, we're talking about volatility, we're talking about just the general risk notion. Setting risk parameters does matter. I want you to know that. It's not that we walk into every day in this world with inherent risk. Now, by the way, as an advisor for nearly 2 decades, when we talk about market risk or someone wants to quantify risk, I have to almost stop them and make sure we understand that, in economics, we learn that there's multiple different types of risk. There's interest rate risk, there's buying opportunity risk, there's opportunity cost risk, there's credit risk, there's inflation risk, interest rate risk, market risk, capital loss risk. I can go on and on and on. So we're just talking about generalizing one risk of market risk, but the reality is by removing one risk, we inherently still have others. So setting risk parameters is a really important factor here when it comes to portfolio construction. And also knowing that if we can reduce volatility and variability, we may be better able to control the emotional response to variability, which we all have, especially the variability when it comes to the downside variety. Now, of course, I think, let's just reiterate here, there are always bumps along the way when it comes to long-term investing. Like if it just went all the way up, straight up in a linear line, no one would have an issue with the markets, okay? But because the market, let's just break it down for a second, as I shared last week as well, the market is made up of you and I. We are the market. Emotional human beings. We are the market. But we prefer here at One Capital to focus on the steady upward slope of what we call wealth building over time, rather than, I think, the jagged lines of the day-to-day, quote-unquote, volatility graph. So let me put a bow on this week and just say this. As you read or hear about market volatility in the future, as you undoubtedly will, just remember this. Don't think of it as volatility or risk. Think of it as variability. You can talk with your friends about this and look smart. Don't think about it as volatility or risk. It's variability. And then, remember, recall the old story about the young man who found himself next to the late J.P. Morgan. Hoping to capitalize on the moment, he asked the famed financier his opinion on the future course of the stock market. This is what Morgan replied. Young man, I believe the market is going to fluctuate. Hey, I want to thank you for listening to the Make Your Money Matter show. As always, remember, before acting on anything discussed today, speak with a financial advisor near you about your specific situation. Or again, if you'd like our help, you can reach us at 805-410-5454 or on our website at onecapital.com. And until next week, always remember to make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.